The next area you're going to look at, Elaine, is intangible assets. And obviously, this is of significant importance and ties in directly into R&D credits.
Yeah, it does. The main areas of FRS 102, Section 18, from a financial statements point of view, that's what section it is, the intangible assets. But if there are any of you interested in more information relating to the tax considerations of R&D, such as handling R&D inquiries, the nuts and bolts of R&D claims, the opportunities and the danger areas, the R&D autumn 2021 updates, the basics, the recent changes, everything you need to know, then please do check out the pre-recorded webinars. We had guest speaker Mr. Simon Britton on, and they're available to view at www.cpdstore.co.uk.
Okay. I'm actually going to give you a code. I'm going to give you a code later in the session, which will actually give you free access to one of Simon's R&D credit webinars. So if you hang on and stick with us here, we'll be giving you free codes and links to a Simon Britton webinar.
Brilliant. So what is an intangible asset other than goodwill? It is an identifiable non-monetary resource with no physical substance, controlled by the entity, from which future economic benefits are expected to flow. I've outlined those three key words that are in that sentence: identifiable, control, and probable expected future economic benefits. So that's really the crux of that definition. When is the intangible asset recognized in the financial statements? So an entity shall recognize an intangible asset as an asset if and only if it is probable that the expected future economic benefit that is attributable to the asset will flow to the entity, and the cost or value of the asset can be measured reliably. So it's the economic benefit flowing to the entity. And that goes on then. The focus area that I'm going to look at is the internally generated assets, because that's, what is relevant to that grant that's on offer there in Innovate UK. When does an internally generated intangible asset meet the criteria for recognition? To assess whether an internally generated intangible asset meets the criteria for recognition, an entity classifies the generation of the asset into a research phase and a developmental phase. Research phase says, the research phase, no intangible asset arising from research shall be recognized. Expenditure on research shall be recognized as an expense when incurred. I think that's a really important distinction. If you're in the research phase, it's going to your P&L to expenses. And, they've even said why, in section 18, they said because you're not going to know whether you're going to get economic benefits at the research stage. So that's why they're expensing it to the P&L. Then the development phase, an entity may recognize an intangible asset arising from development if and only if an entity can demonstrate all of the following. And that's section 18.8H. There's loads in there, but the main things that's coming out of that, it all says available for use or sale. There's about 6 of them, and the main word popping up there is use or sale. And then the last one is measure reliably the expenditure attributable to the intangible assets. So I'm going to go on to the next slide.
And that measuring reliably the expenditure, that's obviously going to tie in very closely to claiming the R&D tax credits anyway.
Yeah, exactly. And it's even the section is making you maintain that documentation. If you don't have the documentation, you're not going to be able to claim your R&D, when you go to apply for the grant, or when you go to kind of justify it to the HMRC. So it's so important for you as the accountant, if you're maintaining those records, or to advise your client correctly that they need to be maintaining those records correctly. So what is the initial measurement basis? That's what we need to look at when we're trying to measure what are we capitalizing. So as we said, the key point there is that the development costs, the development activities should be capitalized if they satisfy all of the conditions in that 18.8. If they don't, they get expensed to the P&L. So we've got that capitalized expenditure now, so we can move on. How are we going to measure that? So an entity shall measure an intangible asset initially at cost. So how much did you spend developing that intangible asset? And then I'm going to skip on here to section 18.17. It goes on to say expenditure on an intangible item that was initially recognized as an expense shall not be recognized at a later date as part of the cost of an asset. So you can't change your mind. Can past expenses be recognized as an asset? No, they're very straight to the point on that. So what are my measurement of options after initial measurement? Well, after initial recognition using the cost model or the revaluation model. So the cost model, an entity shall measure its assets at cost less accumulated amortization and any accumulated impairment losses. The requirements for amortization are set out in section 18.19 to 18.24. And then the revaluation model. It's being an intangible asset shall be carried at a revalued amount being its fair value at the date of revaluation less any subsequent accumulated amortization and subsequent accumulated impairment losses, provided that the fair value can be determined by reference to the active market. The requirement for amortization is again set out in 18.19 to 18.24. So the key point here is that you have two different measurement bases, yet the same amortization requirements apply. So that's the initial hurdle that you need to get over. What way are you going to measure it, cost or revaluation? And then you can move on to your amortization and nail that down. Okay, so if I go on to the next slide here.
And we also need to dovetail in here what Elaine is covering with what Lindsay identified, which was identified by the FRC and by the Chartered Institute in their work in terms of the link here to impairment and valuations of intangible assets. So the real life weaknesses are definitely applying here to what Elaine is talking about.
Absolutely. And what amortization rules apply? So there are two main rules. Excuse me. Yeah, so two main rules to keep in mind of the scenarios there. So an entity shall allocate the depreciable amount of an intangible asset on a systematic basis over its useful life. The amortization charge for each period shall be recognized in the profit or loss unless another section of the FRS requires the cost to be recognized as part of the cost of the asset. This does come up, that we need to put it to a different part depending on what the FRS says. So you do need to consider that, and that is there. For example, the amortization of an intangible asset may be included in the cost of inventories or property, plant and equipment. And rule 2 there on amortization is if in exceptional circumstances an entity is unable to make a reliable estimate of the useful life of an intangible asset, the life cannot exceed 10 years. So it's great that they have that in there. You're not in doubt as to how long you're supposed to spread it over. There is a max there, it's 10 years. So at this stage, we're happy that we have an intangible asset. We're happy that we have applied the correct amortization. And what do we need to disclose? Like, that's our final consideration now. We've treated it correctly. What do we need to tell the users of the financial statements to give a true and fair view? Okay, so what we're going to disclose there. So I've got them, the kind of key bullet points of the disclosures outlined on the slide there. An entity shall disclose for each class of intangible asset the useful lives or amortization rates and the reasons for choosing those, the amortization methods used, the gross carrying amount and accumulated amortization at the beginning and the end of the reporting period, the line item in the financial state or in the statements of comprehensive income, in which the amortization of intangible asset is included, and a reconciliation of the carrying amount at the beginning and the end of the period, showing separately additions, disposals, acquisitions, revaluations, amortization, impairment losses. So again, reverting back to Lindsay, they're looking for those impairment losses to be reconciled, and any other changes. So essentially you're disclosing how you have calculated the amortization, why you have calculated it in that way, and the total amortization at the start and the end, and all the bits in between, all those reconciling and carrying amounts from the start and the end. Another key disclosure that is needed: an entity shall disclose a description, the carrying amount, and the remaining amortization period of any individual intangible assets that is material to the entity's financial statements. I think that's important. Further disclosure requirements are outlined throughout section 18.28 to 18.29a. But the above, I think, are the key and most common disclosures that you as accountants need to be focusing on. So just to conclude on that section 18, as an accountant, you're making a clear distinction at the very start of the engagement as to whether the expenditure is research or development. You're capitalizing the development expenditure as an intangible asset, and you're allocating the depreciable amount of an intangible asset on a systematic basis over the useful life. And then you're ensuring that the relevant disclosures are made in those financial statements. And I just can't stress enough about maintaining those R&D records, Des. You know, it's so important.